In IFRS 17, an alternative, simpler model named premium allocation approach can be used for some short-term contracts, those less than a year, in calculating pre-claims liability. Premium received on day one or unearned premium component, along with any upfront acquisition cost component, are recorded as a current liability and a cash item in the asset. This is because the coverage period is yet to pass and the premium has not actually been earned. As insurers are gradually released from risk as time goes by, the unearned premium flows from liability to revenue account. It's a much simpler model than BBA and can be used for short-term general insurance, life or certain group contracts. The variable fee approach is a variation of the building block approach. It applies to with-profit contracts, unit-linked contracts, equity index-linked contracts, and etc. These contracts are life and pension contracts. Investors' fund is invested into a mixture of assets to average out the volatility in the market, providing a smoothened return. A substantial share of returns from these items are paid out. For these contracts, VFA is more suitable as it links liability to underlying asset items invested. The principle of VFA is similar to BBA, but the changes in assets supporting insurer's share is recognized in the CSM. CSM is accreted at current interest rate. Changes in the value of options and guarantees are recognized in CSM, but are allowed to present in P&L when there is risk mitigation. IFRS 17 is a technology-heavy change program. Its impact would be profound, not only on financial and actuarial function, but also other business functions such as product design and business planning. It puts further requirements in data systems on top of Solvency II. Calculation of CSM is a major undertaking for data collection, storage and processing, and IT architecture, as it requires much more granular levels of measurement. Many contracts previously under PAA now have to be calculated through BBA. IT, finance, risk, actuarial, and business teams are all key stakeholders. IFRS 17 introduces greater volatility on P&L, which means it requires more advanced forecasting and simulation capabilities to make financial forecasts. In summary, IFRS 17 is a financial reporting standard for insurance companies that has to be implemented by 2021. It specifies which liability calculation model to use and how it's used in each type of insurance contract. It's a major technological undertaking and has wide impact on other functions as well.